Hello, neighbors, and welcome back to the neighborhood. I am Squealer D, and I am back again. And yes, my dears, we are back in the investment world. You know what I'm talking about: stock markets and money, dinero. Squealer D, the D is for dinero, and we are learning how to work the stock market. We're learning about everything. If you go back in our folder, it's called Stock Market Learning. Clever guys, right? Stock Market Learning. That's what the folder's called. And it is a playlist of 15 previous live streams. And it is everything that we have learned about stock market learning. We are using mostly Investopedia right now, which is a great resource. It is 100% free. And we are also using Thinkorswim, which is by TD Ameritrade, and that is also 100% free. So anything that you learn here with me, you will be able to do also for free. You could do it along with me and learn. Guys, this is easier than you think. It's a lot of work. Don't get me wrong. We will have to use our noggins and think and learn. But it is not that hard. So today we are still learning different order types. There are lots of different ways you can order a stock or a put or a call or other things. So we have to know how to buy and sell before we buy and sell, or we'll be stuck like me my first 2 weeks of trading, not knowing how to sell something you bought and losing money. And we do not want to lose money. Our biggest thing when we're learning this is to learn what, guys? Risk management. And risk management will manage our risk, manage our loss, guys. And that is our goal. So let us get started. Yesterday, we only went over the two basic market orders and limit orders. And we read those and we tried it on Thinkorswim. So we gave it a go. Today we are going to go over market and limit orders and do some of these additional stock order types. And we're going to look at those also. So start back up here, guys, with a market order. Anybody remember what a market order was from yesterday? It is the basic order that gives you immediate execution, right? A market order is the most basic type of trade. It's an order to buy or sell immediately at the current price. And that is whatever is near the asking price. So a market order is the most basic type of trade. It's immediately at the current price, whatever the asking price is. And yesterday, for our example, we bought some Roblox and it was $62.05 was the current bid price, but we paid $62.40. So we paid 30 cents over what the current price or the market price was, because that was the closest asking price, so we could get it immediately. So a market order, guys, immediate. And you might pay more than what is up on the screen because they get it to you immediately. So market orders are popular among individual investors who want to buy or sell a stock without delay. The advantage of using market orders is that you're guaranteed to get it filled. In fact, it will be executed as soon as possible, ASAP, guys. As soon as it can happen, it will happen. Although the investor doesn't know the exact price at which the stock will be bought or sold, market orders on stocks that trade over tens of thousands of shares per day will likely be executed close to the bid-ask price. If you're selling 100 stocks, you're probably, or buying, you're going to get whatever's available. But if you're selling all the stocks, like they said, tens of thousands of shares, if you're selling like 4,300, 110,000 shares, like, it doesn't really matter. You are going to get the price you want because you're controlling a large majority of the shares. So that's not us though, guys. Right now, we have to worry about market orders because it could take 30 cents per share. If you buy 100 shares, that's $3. If you come in with a $3 loss on a market order, it doesn't seem like a lot until you're trying to make that $3. You know what I mean? Like, we are trying to grow our folder. We're trying to grow our money, not lose money. So we have to take very good account of all the orders we do and what their cost is. So a limit order is referred to as a pending order. It allows investors to buy and sell securities at a certain price in the future. This type of order is used to execute a trade if the price reaches the predefined level. The order will not be filled if the price does not reach this level. In effect, a limit order sets the maximum or minimum price at which you're willing to buy or sell. For example, if you wanted to buy a stock at $10, you could enter a limit for this amount. This means that you would not pay 1 cent over $10 for that particular stock. However, it is still possible that you could buy it for less than $10 per share specified in the order. So a limit order will not make you pay more, but you could pay less, which that's a good thing, right, guys? So those are the first two we learned yesterday. Today, there are 4 types of limit orders, and those we did not go over. So a limit order is sometimes called a pending order, and you could set the amount. So a buy limit is an order to purchase a security at or below a specified price. Limit orders must be placed on the correct side of the market to ensure they will accomplish the task of improving the price. For a buy limit order, this means placing the order at or below the current market bid. A sell limit, in order to sell a security at or above a specified price to ensure an improved price. The order must be placed at or above the current market ask. So if you want to sell it, of course, you're going to put it, where you make more. If you want to buy it, you're going to put it low so you pay less, guys. You want deals. Think of that with limits. You're putting up limits so you don't pay too much. A buy stop is in order to buy a security at a price above the current market bid. Why would you want to buy a security? Why would you want to buy a security at a price over the current? A buy stop. In order to buy a security at a price above the current market bid. A stop order to buy becomes active only after a specified price level has been reached, known as the stop level. Buy stop are orders placed above the market, and sell stop orders placed below the market. The opposite of buy and sell limit orders. Once a stop level has been reached, the order will be converted into a market or limit order. Oh. I don't know why you would want to use a buy stop. Why would you use a buy stop order? A buy stop order is placing an order to buy a security at the market price, and the order gets activated only when the security price reaches the stop price specified in the order. It's used to reduce risk, limit the losses, and protect the profit associated with the position. Okay, I get it. It's for risk. So is it it's a type of limit order. What is the difference between stop order versus limit order? Let's see what the difference is, guys. It's a type of limit order, but what is a stop order? Okay. Different types of orders allow you to be more specific about how you would like your broker or yourself to fill your trades. When you place a limit order or a stop order, you tell your broker that you don't want the market price, the current price. Instead, you want your order to be executed when the stock price merges a price you specify. Okay? Right? A limit order uses a price to designate the least acceptable amount for the transaction to take place, while a stop order uses a price to trigger an actual order when the specified price has been traded. A limit order uses, hold on guys, I'm processing this in my little brain. Some things are really hard to process and you just got to get it. A limit order uses a price to designate the least acceptable amount for the transaction to take place. Well, a stop order uses a price to trigger an actual order. Okay. I get it, guys. I get it. Let me explain it in Donna terms. Okay. So, A limit order is what we place and everybody can see it. Let me show you guys. I got this. So let us bop over to my Thinkorswim. Where will you Thinkorswim? Okay, here we go. We got you. So here we are on my Thinkorswim, guys. This is our buying power. Don't forget, these are these little tabs. These are our trader tabs, remember? We need to know these tabs, guys. There's 8 of them. Most important tab, education. We're going to learn everything there is to learn. Monitor, this is where our orders are working. This is where our orders will be working orders, fill orders, canceled orders, rolling strategies. Here's what we have open. We still have this open? We never sold our Peloton from yesterday? Huh. I do know. What did it? I don't know what this is. I'm gonna be honest with you. I have no idea. I bopped into here and found something even more confusing. I thought we sold everything yesterday. What did this do? It says the trade happened yesterday. I don't know. Let's see. Okay, so here it is. I don't know. Let's do a limit order and see. That's, you guys see what that is? That's a limit order. 50. So it'll limit. Remember we did a limit order at 987 and confirm and send it. Go over here. Here it is in our working orders. I don't know what this is. So let me go over here to our chart and I'll show you. So limit order, guys, this is what I meant about it will show you. You see how we have this right here and everybody can see it right here. It's here, limit. Buy 50 of them. Somebody else wants to buy some too. So if it hits this, the limit order will everybody can see it. It's already active. So we have an active limit order. Now, what the article is saying, if instead we used a stop order, then instead of a limit order, if we used a stop order, which is, let's see, market, okay, that's a stop. Okay, so a stop order will buy it at 988 and that will trigger it. It won't show up here to everybody. And I don't know, guys, yet if it matters that people know, but it might matter. Like having this out there for people to see, that might change the volume, people trading because they see that you want to buy it, manipulate volatility. So maybe it's helpful to have a stop order that isn't going to show up to everybody until that price activates, and then it will activate and then it will make the trade. So it's like a limit order, but it's sneaky. Let us go back in here and see, did we make our trade? I'm going to be honest with you. I don't know what's going on with our orders. Okay, I don't know. Studies. I don't know what's wrong with my clicker. This little guy here, it's ridiculous. Oh, oh, oh. You got to go over here, guys. Drawings, drawing tools. And this is a pointer. Look at my little pointer. He's got a hand. Drawing tools. This guy. So this is the Peloton. Peloton selling for $987. And I don't know where our stop order went. Did we just sell or did we just buy? No. Where does it go? I don't. Oh, there we go. I don't know. We canceled it. I don't know what this is, guys. I'll be honest. Yeah? I reset it and I didn't mean to. I didn't know it would reset everything. Lesson learned. Lesson learned. That's okay. We didn't know what was going on. So lesson freaking learned. So the difference between when you buy an order, the difference between edit your order. You see these different orders, guys? What will a market order do? If we buy a market order, that will give us 100 shares of Peloton at whatever the market price is. And if we go over here, guys, remember this is our level 2. This shows us our spread. Right now, there are 28 times 989 is the asking price, 990. That's a really close spread. 89 to 90 is really close, guys. So, you see how it's kind of just jippling around here? That's not a word, jippling. I don't know. But we had a lot of volume here. You guys, these are the volume lines, remember? We got some volume. We had more volume this morning when it was going wonkity donkity. And now it's less volume. See all these blue lines mean people trading. That means volume of trading, like people buying and selling. So you see all this and how wonkity and volatile it was. And then you see right here how there's really not very many people and it's less wonkity, less volatile. That's because trades make volatility and volatility makes price change. So let's see, what else do we have over here open? Ape, AMC. Woo, AMC looks funky. What is up with AMC today? AMC's at a $1.61. Man, AMC. Let us see Apple. What's Apple? What's doing up with Apple? What we got looking at Apple? Apple's sitting at 165. What is the... You guys always got to pay attention to what we're looking at because 1 day, 1 minute shows today's. You see, this is today's trade. We can zoom on in. Let me close this so we can control our... You can flatten this a little bit more. Look, guys. 3 up. Is that 3 soldiers? Okay. So let's go back over to our limit orders. So a limit order uses a price to designate the least acceptable amount for a transaction to take place, while a stop order uses a price to trigger an actual order. So remember what we learned. A limit order and a stop order are different because a limit order shows up and everybody can see it, while a stop order will be in there and it can take place at that acceptable amount, but it doesn't trigger until it actually hits that specified price. And then it'll trigger an order. So it won't be there just sitting, waiting. So people won't see what you're doing. It's like a sneaky order. Think of it like that. A limit order specifies a price. A stop order will trigger the actual order when that price has been traded. So a limit order can be seen by the market, while a stop order can't be seen until it's triggered. For example, if you want to buy an $80 stock at $79 per share, then your limit order can be seen by the market and filled when sellers are willing to meet that price. A stop order will not be seen by the market and will only be triggered when the stop price has been met or exceeded. Limit and stop orders indicate that you want to buy or sell a security at a specified price rather than the market price. A limit order is visible to the market and instructs your broker to fill your buy or sell order at a specified price or better. A stop order isn't visible to the market and will activate a market order when a stop price has been met. Although stop orders avoid the risk of no fills and partial fills, you may end up with a lower price than you expected. Wouldn't you want a lower price? Why would it matter? A lower price on the stock, or wouldn't it be great to get a lower price than you expected? If you thought you were going to pay $79 for it and you got it for $78, wouldn't that be a good thing? Although you may end up, doesn't that sound negative? It should say using a stop order can actually get you a lower price than you expected. I don't know. A stop limit order combines the features of both a limit and a stop order. Okay. A limit order to buy or sell a certain security for a specified price. One thing to keep in mind is that you cannot set a plain limit order to buy a stock above the market price because a better price is already available. So if you wanted to purchase shares of $100 stock at 100 or less, you could set a limit order that won't be filled unless the price that you specified becomes available. Similarly, you could set a limit order to sell a stock when a specified price is available. Imagine that you own stock worth $75 per share and want to sell if the price gets to 80. A limit order can be set at 80, which will be filled only at that price or better. Just remember that you cannot set a limit order to sell below the current market price because there are better prices available. In a regular stop order, if the price triggers the stop, a market order will be entered. If the order is a stop limit, then the limit order will be placed conditional on the stop price being triggered. Thus, a stop limit order will require both a stop price and a limit price, which may or may not be the same. Okay, guys, so these are things you do for risk management. So these are things we have to understand, because if you place a regular stop order and it triggers, you're going to have to use a market order. And what did we learn yesterday about a market order? That we paid almost 30 cents extra per share when we ordered the market order rather versus the limit order. So if the order is a stop limit, a regular stop order will use a market order. But if you use stop limit, then a limit order will be placed conditional on top of the stop price being triggered. So the stop would say at $80, like for this example, the stop would be at 80, and then maybe your limit order would be at 82, or they could not be the same. Maybe you put your stop order in at $80 and you want your limit order at $81. I don't know. So stop orders come in a few different variations, but they're all effective, conditional, based on a price that is not yet available in the market when the order is originally placed. So if you want to buy or sell something and the price is not there yet, you could put a stop order. When the future price is available, a stop order will be triggered. but depending on its type, the broker will execute them differently. Many brokers now add the term stop on quote to their order types to make it clear that the stop order will be triggered only when a valid quoted price in the market has been met. For example, if you set a stop order with a stop price of 100, it will be triggered only if a valid quote at 100 or better is met. A normal stop order will turn into a traditional market order when your stop price is met or exceeded. A stop order can be set as an entry order as well. If you wanted to open a position when the price of stock is rising, a stop market order could be set above the current market price, which turns into a regular market order when your stop price has been met. So limit orders are visible to the market and stop orders aren't visible to the market. A limit order tells brokers to fill, buy, or sell at a specified price or better. A stop order activates market order when stop price is met. So you set it at $12, and then once it hits $12, you have a market order automatically set into there to buy. So a stop limit order has the features of both the limit and stop order and consists of two prices, a stop price and a limit price. This order can activate a limit order to buy or sell a security when a specified stop price is met. For example, imagine you purchase shares at $100 and expect the stock to rise. You could place a stop limit order to sell the shares if your forecast was wrong. If you set the stop price at $90 and the limit price at $90.50, the order will activate if the stock trades at 90 or worse, but a limit order will be filled only if the limit price you selected is available in the market. If the stock drops overnight to 89 per share, which is below your stop price, the order will be activated, but it will not be filled immediately because there are no buyers at your limit price of $90.50 per share. The stop price and the limit price can be the same in this order scenario. So remember, limit orders might not be filled. If there's nobody to buy or sell what you want at that price, they're not going to be filled. Market orders will be filled. They will give you will pay whatever price is available and you will get the order. So a stop limit order has two primary risks, no fills or partial fills. And you have to work this into your risk management, guys. I know I'm going to say it a million times. Risk management. Maybe you will miss out on making a couple $100, maybe a couple $1,000. Guys, we're going to be doing little. You're not going to be making $10,000 per trade. You might make $5 and be happy, and that's okay. $5 to sit there and click a couple buttons, it's good deals. But we have to have risk management so we don't just sit there and lose $5 all the time. That's no good. It doesn't matter how much you're losing. You don't want to lose. You know, try to lose as little as we can. So we have to be okay in our brains right now. Remember, no fear, no greed, guys. We cannot care if we miss a deal, if we miss buying in on something. We can't care. We want to get in on stuff. We want to make money, but we can't care like that. So we have to understand these risks that you might not feel it, or you might just get part of it. Like maybe you wanted to buy 100, but they only gave you 30, a partial fill, guys. We have to accept that as risk management, because if you use a market order, you might pay more and lose more, and then you're stuck with these shares that you paid too much for. That's a way worse situation than putting a stop limit order and not getting it filled. Look at it this way: not spending the money, missing out on a deal is better than losing money on the deal. So make it okay in your head that we're doing this slow. Your money will grow slow at first, guys. That's what exponential growth is and compound wealth is. You compound it, guys. Think of making a giant compound. It's big, right? You're making a compound. Make it big. So how do you make something really big? Well, you build the foundation, right? That's your foundation, guys, right up there. I promise you. For money, your foundation is your brain. If you don't teach your brain how to control money, if you don't teach your brain greed and fear and how to control those two things, you will make unnecessary risks and you will go broke. Google it. And this is why people don't trade in the stock market. Did you know that TD Ameritrade only has 11 million people trading on it? One of the biggest trading sites, guys, TD Ameritrade, has 11 million people trading on it. And you say, but Squealer, 11 million is so many. No, it's not. 11 million is only half of the actual millionaires in the United States. 22,000 millionaires. Or 22 million millionaires. And only 11 million of them are on TD Ameritrade. And I get it. You're going to be like, Squealer, not everybody uses TD Ameritrade. There's a lot of people that don't use that. I got it, guys. I got it. There's probably another 11 million on another app. But my point is, why isn't there 300 million on TD Ameritrade? You guys know how many people are in America? Like 350 million people are in America, right? Okay, 350 million Americans, guys. And we only got 11 million people on TD Ameritrade. You guys want to know why? Because they don't want you there. Because more people on TD Ameritrade means less trades and money for them. There's only a certain amount of money, guys. There's only a certain amount of trades that can happen in the world. There's not unlimited money. I know that you see these people printing up money, but there's not unlimited money. Just like there was not unlimited gold. There's not unlimited resources, gas. So they don't want you on TD Ameritrade. They don't want you on Webull. They don't want you even on Robinhood. Even though they set Robinhood up so they could shut it off and turn you off so you can't do your trades, they don't want you on it. You guys Google that. Google the fact that Robinhood shut traders down when things got hairy. They started trading all of that game crazy. What is it called? GameStop. Yeah, GameStop, guys. They started trading all that GameStop. They got the apes off of Reddit in there. And you know what happened? They shut Robinhood down on them. They didn't let them trade. They stopped all trading of that GameStop stock. For anybody on Robinhood, guys. And you guys want to know who uses Robinhood? It's not Warren Buffett. You guys, Warren Buffett does not use Robinhood. Well, maybe he does use Robinhood, but that is not what I'm talking about. Warren Buffett, let me rephrase, he may use Robinhood. Maybe he likes to keep an eye on things. I don't know. But Warren Buffett does not make the majority of his money on Robinhood, nor does he keep his money in Robinhood so that they can rob him. Not Warren Buffett, y'all. Do what Warren Buffett does. Warren Buffett is getting smarter even as he's dying. That man is ridiculous. So what I'm telling you is they don't want you here. They make it confusing so you will go away. I'm serious. I'm not trying to be funny. I'm not trying to be mean. If we all become millionaires, guess what, guys? There won't be such thing as a millionaire. We'll all just be normal people, and it'll cost millions of dollars to live. They don't want that. They want to be millionaires, and they want you to make $30,000 a year like a modern slave so that they can make money off your back and be rich. Not everybody gets to be rich. That's why the Republicans and everybody else tell socialists that it's a dream. Not everybody gets to be the same, because then some people can't use other people. Guys, if we all live in a house and we all had the same responsibilities, all of us, how will we get things done? That's what the Republicans think about money. They think if everybody's in the kitchen, then they won't be able to get their food because there'd be too many bodies in the kitchen. So they're going to try to scare you away. And what they try to scare you away with is loss. They try to scare you away from everything with loss, though. They tell people, don't trust people because you'll lose them. They tell you, don't trust companies. They tell you, don't trust each other. Guys, trust your brain. For once in your life, trust your brain and get smart. Because that's what they don't want you to do. And you know how I can prove that they don't want you to get smart? Look at the state of our public schools. Look at the state of our public school systems and how much money, financial information they give you. Think about it. I've graduated 2 different colleges with 2 different Associate of Arts degrees. I've graduated a high school. I've graduated, I don't know. I've graduated lots of stuff. But guess what? I never got any type of investment or money knowledge. I went to school almost 30 years of my life from the time I was a little tiny infant. And I never learned investing or money management or anything. Nothing. Because they don't want us to learn it. Because if we learn it, we can control it and we can partake in it. And if we all partake, what happens for them? There's less for them, guys. If we go in eating candy out of the candy bowl, there's going to be less candy for the parents, right? That's why a lot of parents are greedy and don't share their candy. Don't let them be greedy with you. Get your own candy bowl, guys. Get your own candy bowl. Start putting candy in the candy bowl. And then mom can't tell you to keep your freaking hands out of it. Okay? So here we are. We're getting our own candy. So we have to learn these orders. They want you to make a mistake on these. They want you to not understand it, because if you don't understand it, you can't play. So if we have to go over these order types 17 times, we're going to go over them. So no fills or partial fills on a limit order. And on a market order, you might pay more than you want. So if you used a stop limit order as a stop loss to exit a long position when the stock started to drop, it might not close your trade, leaving you with less valuable shares that could continue to decline. So if you used a stop limit order, is what they're saying. Remember the limit part, guys? The limit might not get filled. So if you use that to get out of a position so you don't lose all your money, you might still lose all your money. That's what they're telling you. You got to know this. Even if the limit price is available after a stop price has been triggered, your entire order might not be executed if there wasn't enough liquidity at the price. For example, if you wanted to sell 500 shares at a limit price of $75, but only 300 were filled, then you may suffer further losses on the remaining 200 shares. A stop order avoids the risks of no fills or partial fills, but because it's a market order, you may have your order filled at a price that's worse than what you were expecting. For example, imagine that you have a stop set at $70 on a stock that you bought for $75. The company reports earnings after the market closes and opens the next day at $60 per share. Your order will activate and you could be out of the trade at $60, far below your price of $70. So that was a stop order, guys. You see how far below the order you could go, and it will sell it. But you'll end up with $60 and you lost $10 a share. If you use the limit stop or stop limit, you might not even have all of your trade sold. This is where good risk management comes in, guys. We need to plan ahead for this. And that is how you avoid it. And I know what you're thinking. How can you plan ahead for there not being enough liquidity? Well, we can look liquidity up, guys. We can see what is the state of liquidity in businesses. That is where technical analysis come in with your risk management. You have to know how to do this. That's what I'm talking about learning, guys. We have to know, because if we don't, all we're going to do is go in and lose money. We're going to go in and buy 500 shares and we're not going to get 200 of them sold, and we're going to lose all the money we could have made on those 200 remaining shares, and everything's going to be a waste of time. We don't have to waste our time. We can sit here and learn, and eventually we will be able to make money. What else are you doing right now? What else are you doing? An hour a day with me to learn this stuff. What else are you doing? Maybe you don't like me. That's okay too, guys. There's other people that will teach you this. Look, I'm learning it all by myself on Investopedia. And if I can do it, you can do it. It's reading. And if like me, sometimes you don't understand something you read, that's what the internet is for, guys. There's videos everywhere. Investopedia, I don't watch them on here because I don't want to watch somebody else's videos like on my stream. I think it's kind of rude. I think that you should go, you should go to their website and you should watch it yourself, because they deserve that view and they deserve your traffic on their website. That's how I feel, at least. So I don't really show videos, but there are videos, guys, that break this down for you. They show you. Do you learn better by watching? Go watch all those videos. And then when you learn it really well, come back here and share all your nuggets of knowledge with me, because I need them. We can help each other out. And guess what? We're not going to make everybody rich. We're not. Unfortunately, I wish that this video could be watched by everybody in the United States, and 98% of us could all learn how to trade on the stock market. We could blow up the stock market and end this crap. That's what I wish. I honestly wish that all those rich people would lose every single dollar they had and reset our money system so that we don't need $1 million right now for retirement. What is my daughter, who's 11 years old, going to need for retirement, guys? $7 million to retire? $10 million to retire? What is our children going to need to retire? I don't know. But I know that if we don't get in now, when are we going to get in? When they shut down TD Ameritrade and don't let you in? That's what's coming. If you don't get in, they end up closing the way to get in, guys. They always do. Everything good always closes to the public. Think about it. They start charging more. Like right now, TD Ameritrade is free. You can go on Thinkorswim right now and you can learn for free. You can go on Investopedia. They do have an academy where you could pay, guys, but everything else is free. They have all these examples, facts. They have everything you ever needed. They even have a simulator where you could practice trades on Investopedia, guys, for free. It's just too much free stuff to get smart. And if we don't take it, it's like we're leaving free money on the table. The big guys, they came in and counted their money, and some of it dropped on the floor and on the counter. And it's up to us to go in there and pick it all up. Like, do you have too much pride to go pick up some money off the floor? Not me, because the big guys are just throwing it around. Trust me. They have it to throw around like that. So a stop order avoids the risk of no fills or partial fills, but because it's a market order, you may have your order filled at a price that's worse. Okay, got it. And a limit order, it might not get filled at all, guys. So 2 types of stops. So here's a hypothetical example to show you how limit orders work. Let's say a trader wants to invest in stock of company A. Okay, the stock trades at 10 per share, but they believe the stock will drop down to their desired limit of 8. They decided to place an order of 100 shares at a limit price of 8. A few days later, the price drops below the $8 limit, which means the trader can purchase shares until the price reaches the limit. Now let's look at how the order works on the sell side. Let's say you want to sell the same company stock, which trades at $15 a year later. You feel that that's too low and your limit for selling is $20 per share. You can set a limit order to sell 100 shares once the stock price reaches your limit. Now let's take a look at how stop orders work using the following example. Say you want to buy company B stock, which trades at $25, but you believe the price will break above that threshold. You could place a buy stop order by placing a limit on the price of $26.75 per share for 50 shares. As soon as the price reaches your preset limit, the order turns into a market order and it goes through. Here's how it works on the sell side. Let's say the company's stock trades at 25, but you want to protect yourself from a big drop in price. So you decide to set a limit at 22. If there's a drop and someone sells it below 22, this triggers your order. This means that the order becomes a market order and you can sell at the next price available. So a limit order sets a maximum price that you're willing to pay or a minimum price that you're willing to accept on a sell. Whereas a stop order is triggered when an asset reaches a certain price and filled at the next available price. Also, limit orders are visible to the market, while stop orders are not visible. What are the pros and cons? With a limit order, you can set the ultimate price level that you're willing to accept on a transaction, but you risk your order not going or your order going unfulfilled, like it might not get filled, guys. A stop order allows you to enter or exit a position once a certain price has been met. But since it turns into a market order, it may be filled at a less favorable price than you expected. So, a stop limit order allows you to trigger an order at a specified stop price and then carry out the transaction, only if it can be completed at a certain limit price. The risk of a stop limit order is that it may remain unfilled or be partially filled. So, most traders rely on technical analysis to decide where to place their orders. For instance, trendline analysis may reveal an ongoing up channel, which you could then use as a basis to get the long market. You would identify the price level of the lower trend line as an optimal point of entry and place your orders accordingly. The same goes for Fibonacci levels, Bollinger Bands. Hey, we looked at Bollinger Bands, Ichimoku, and other sources of support. So the bottom line, rather than entering a market order, which instructs your broker to buy or sell a security at whatever price is available at the moment, order types like limit orders and stop orders allow you greater control over your trade. Market participants can see when you have entered a limit order, which tells your broker to buy or sell an asset at an indicated limit price or better. A stop order, on the other hand, cannot be seen by the market until it is triggered, and it directs your broker to buy or sell at the available market price once the asset reaches the designated stop price. So, those are the basic orders, but there are so many more, guys. I watched a video a couple days ago about an OCO order, and it's called One Cancels the Other, OCO. And I don't know a lot about it other than it's an order that cancels another order. So you could have two different types of orders in there. And once one goes, it's kind of like a stop order where it turns into a market order. But this allows you to have a high and a low. So if it goes up too high, you're gonna sell it so you can get your money. Or if it goes too low, you could sell it so you don't lose your money. And that order sounds really great for us, so we will look into it next time. It's called One Cancels the Other. And if you know about it in the comments next time, maybe I will get, and you can tell me about it before I tell you, I'll give you a prize. I got prizes, guys. Lots of prizes. So I think that that's it for today. We were going to go on and make a couple little trades, but after I messed up my Thinkorswim, I got to go look at it. You're going to go check it out, make sure I'm doing things right. I don't know what happened. So I don't want to teach you guys wrong. Bad habits are hard to break, so we only need good habits. Take it slow and learn only the good habits, okay? So hold on, guys. I got a little message. Got a little message on my OBS. Okay. I don't know what it was. But that's it, guys, for today. Like I said, no homework unless you want to find out what an OCO order is. One cancels the other. You know what that is? Tomorrow. I'll be so proud of you. You get a prize. A special prize. A Squealer D prize. Anyway. So I hope that these orders are a little bit more clear today. We'll go in tomorrow and we will try using some of these orders and seeing how they work. So if you do not already have TD Ameritrade, Thinkorswim, get it, guys. Tomorrow we will play with it. We will play with it and play with it and play with it until we're not playing with it anymore. We're using real money, real trades, real rich. Okay, until tomorrow, guys, I will see you. I hope you have a wonderful day. Enjoy what you do and don't be ugly. Act right. It's good for you. See you later, neighbors.